On the podcast with us today is Rama Krishna. Rama, welcome to the podcast.
Thank you, Dan. Thank you for having me.
Well, Rama, I want you to get us started because I know you have a deal that you closed in 2018, and we're going to dive into it. But I want you to start us off by giving the listeners a little bit of a background about who you are and why you like these multifamily investments.
Yeah, sure. So my name is Rama Krishna. I'm a part of Bay Area here, San Francisco Bay Area. I live in Cupertino. I'm any other Silicon Valley. I'm an IT professional, but I have started a couple of businesses, IT businesses before, product and services before. I'm a freelancer right now here in Bay Area. So I was not at all related to any real estate at all till like a couple of years back. 2 years back, I started doing single family homes in Atlanta and Raleigh. And then I wanted to scale. Then this is single families is not the way to scale. I kind of bumped into multifamily, kind of liked it in two ways. One is passive income. Another one is run as a business. You need to see the income, the expenses. It's just run as a pure business than just a real estate. I kind of like the scale, the way it is happen, and also the concept of syndication, which I really like from a fundamental perspective. Kind of grouping like 10, 15, 20 people together, you can buy as big a commercial property anywhere in US, right? That's the power of syndication, which I really like. And in 2018, I started here primarily in my market, like Southeast market, from all the way from the Carolinas, Georgia, and Florida. Those were my focus markets. We closed 5 deals in 2018 and total 153 units.
So we could spend 5 different episodes talking with about your deal.
Yeah, sure, definitely.
Well, I know the one that you have chosen for us to talk about today is the one that people can see behind me, which is Casa Grande, and it is located, you said, in Jacksonville, Florida?
Yes.
Talk to us about why you like Jacksonville, Florida a little bit.
So if you see overall Southeast, like all the way from Virginia to Florida, that's where all the net migration happening. If you see the net migration chart in Texas, some parts of like west coast of like Portland or Oregon, Salt Lake City, those areas, again, a lot of migration happening. But the concentration is happening in Southeast markets from Virginia to Florida, and really like that belt. That's where I kind of invest a lot. And my primary markets were Raleigh, Durham, and Atlanta. Kind of bumped into Jacksonville accidentally because of my single families before in 2017. And I like the story of Jacksonville, the way the population is growing, the jobs are growing. It's top 15 in census from the population, a lot of blue collar jobs, and even IT jobs, services jobs, coming in. Financial tech sector is also coming in. It's just a very diverse market from commerce, logistics, IT services, everything. The story is nice, and then the weather is good. Florida, it's the no tax state, income tax state, everything. And also tucked away into the north near to Georgia, where it's like not that really affected by the hurricanes. In Florida, I like that market really well. That's the reason I kind of chosen that.
So correct me if I'm wrong. Your primary focus has been kind of in that Raleigh and Atlanta markets, but because you had bought some properties in Jacksonville, single family wise, it kind of still was attractive to you. And was it from a broker that you had maybe built a relationship during your single family searches, or was it a different broker?
From the PM, that's where we started. Like from a property manager, they're primarily St. John Properties. They are single family property managers, but they do small multifamily as well. When I told them like I don't want to buy single families anymore, they said like we can help you out in multifamilies. They kind of helped me network with brokers, and then we underwritten so many properties. We got from 20 units. All the 5 properties I bought are in Jacksonville, Florida. Pretty good broker relationships right now in Jacksonville. Since we're closing all these deals. Yeah.
So is this broker that is this the broker that brought you this deal? Is it a broker from one of the large groups, or was it specifically from the property management company and like an off-market deal, or how did you actually find this deal?
This deal is with the top broker, like a top 5 broker in Jacksonville,
Okay.
but it's an off-market. So they kind of bought it like 2014. They've spent quite a bit of exterior stuff. All the units are still classic. The seller has some medical problems. They still need some interpreter to interpret any of our things like PSA, LOI, anything. Took a lot of time for us to come back from sellers. Even the closing, we had to extend it because of the delays. So the seller wants to sell this thing, but we got it through off market before hitting the market.
So how many units is this one?
This is 59 units.
59 units, and you got it off market through one of the top 5 brokers in the Jacksonville market.
Mm-hmm.
And what was it that initially attracted you to this deal?
It's a concrete block. It's just really good construction, no deferred maintenance at all.
You can see behind us the concrete blocks there.
Yeah, so it's a very well maintained property. The Google reviews are really good. The tenants are happy. Really good pool. They maintain it well. This is more like a best property in this submarket. This is more like a Hyde Park specific neighborhood, which is really good from a blue collar, and then close to the West Side Industrial Park, the Cecil Commerce Center that's happening. A lot of blue collar jobs. Well maintained properly from exterior. Even the lender, there's like $3,000 of deferred maintenance. That's it. It's just a solid property. Mm-hmm. So, and then everything is classic units. So you just go. They did renovate it in 2001. It's definitely classic. With the current what's going on right now. So we're gonna make improvements in all half of the units. That's the plan, and then it pretty good cash flow numbers worked out great for us.
So why did this broker send you this deal? Because, I'm sure that this broker has other people they could have sent it to, and maybe they did send it to a few other people, but why did they send this particular deal to you and, gave you kind of like that first, go at it?
Right. So we already closed 3 deals in Jacksonville before this. This is our 4th deal. We're working with this broker from past like 4 or 5 months. Like we're, constantly hitting, like we're talking to them, meeting them for coffee. My PM has relationship with this broker as well. We 3 start together, and they saw that I'm closing these deals. They see that you're not just talking or just submitting offers or anything, but you're closing deals in this market. More like a domino effect. I'm just since this guy is closing, let's just send more deals, right? He sent multiple deals. That doesn't make sense for me from a numbers perspective. Kind of passed on so many. This one looks really solid on a construction side, and all classic. The numbers worked out great, and our leverage was also really great. We got a term sheet from our lender, from Freddie Mac, and then we thought, okay, this is the best deal for us to submit an offer.
And you're located in the Bay Area of California, correct?
Yes.
So at what point did you actually go and tour this property? Was it before you put an LOI on it? Was it after the LOI or under contract? At what phase did you actually tour the property?
No, we saw this property twice. As I said, this is we got this under more like a draft OM. So even if you see, I can send you the OM later on. It's just, he's just drafting this. It's a 3-page OM. It's trying to put prepping up to get into market, right? Yeah. So, when they do this thing, they give you, early access to just go in, but do not disturb the tenants, but you can just go in and then see the property. I saw the property at the time, and, but there's some back and forth on the number. We wanted to actually offer in a different price. Some back and forth on that. I came back here. I saw the property from outside and came back here. We're still negotiating and finally submit an offer later on. But for the interior tour, I couldn't come on that day. But my PM, my lender, they did all the inspection of all the units. They gave me. I already visited 5 times this year, 2018, to Jacksonville, Florida. Because I have other 3 rehabs going on, and then buying properties, acquiring properties, talking to brokers. Early came 5 times to Jacksonville for some other reasons, like for closings, other stuff.
Were you competing with anybody else during the bid process?
I have not got any information that somebody else was there on this, but definitely it took some time, some back and forth on this. As I said, with the seller's condition as well, a lot of delays. So the moment we submit LOI, it takes some week or something. Again, contract, say a couple of weeks. It's just slow progress on this deal. maybe because of the seller's condition, I guess. So
Yeah. Because the seller you said was having some physical issues or something.
yeah, some kind of a late stage Alzheimer's and some other some interpretation problems.
Yeah.
They need interpreter and some memory problems. Yeah, the seller is also from California.
So you didn't have how many rounds of back and forth do you think you went through to get to that stage?
Oh, a lot. It's just
A dozen?
yeah, no, it isn't. It's just the slow progress. That's the problem. Like, keep checking. Oh, we're still waiting for the seller to respond. The PSA has changes. LO has changes. It's just like every item they want to
Back and forth,
negotiate,
back and forth.
back and forth, and every time it took so much time. Yeah, the whole process took I think 3.5 months. Like from the when we saw this property as an off-market OM, this 3-page OM, to close it just took 3.5 months.
Six and a half?
3.5 months.
3.5.
3.5 months. We had an extension also on this, as I said, like 15-day extension. We used our extension to close in 75 days.
And what kind of hard money not hard money, but earnest money did you put up? And did you have to go hard on that money day one, or was it after the due diligence?
After due diligence, after 21 days, we had to go hard.
Okay.
So we initially submitted with financial contingency, but again striked off and then sent it back to us. But we because at the delays that's happening, and also the way we put in is the due diligence time starts when you provide all the documentation to the lender. So that took some time. It kind of had a lot of our initial advantage for us, and by the time we kind of end of the due diligence process, we got to have pretty good knowledge already that, the lender, like Freddie Mac, is already saw our file, everything's good. So we're pretty confident that we can close this property.
And so did you just put 1% up for earnest money, or was there a different amount, or?
No, it's like $100,000, which is close to around 3%.
Okay. Yeah. Which didn't go hard until after 21 days after receiving all the documentation. That's
exactly close to after 1 month, it went hard.
Yeah. I think, a lot of people, when they're putting these deals together, they look at the earnest money deposit, and they might just say, like a standard thing is after 30 days or 21 business days or, 28 business days or whatever, 28, calendar days or whatever, that the money will go, hard. Right. And for those of you who are listening, if you don't know what that means, it doesn't mean he's getting a hard money loan. So that has nothing to do with what we're talking about. This has to do with the earnest money deposit. Like you go to buy a house and you put up $1,000 to reserve your offer on a house and say, hey, I'm serious. That money can be refunded back to you if for some reason you decide to back out, as long as there's contingencies in place. And so the contingency here is that, that he gets 21 business days or 21 days, if you will, to make the decision. Does he really want the deal? But he was smart because he put into the contract that 21 days doesn't actually start until the seller provides you or provides the lender with all the documentation that is required. And I think that's a very key point here that you did that was very smart, because you could have been caught, in a trouble spot if you got all the documentation and it was only like 7 days before, and it takes 14 days for Freddie Mac to give their go ahead.
Yep, exactly.
So I think you did a great thing there, and people who are listening should take that and make sure to take a note of that, to make sure that when they put earnest money deposit before it goes hard, meaning non-refundable, that they need to make sure that they have all that documentation and putting that in place. It makes the seller act a lot quicker because they know that the clock doesn't start until they get all that information.
Exactly. But they might not accept, but you can try, always try.
Yeah. Oh, absolutely. And I think the biggest thing is with that is I'm sure you probably listed out what documents were needed ahead of time, so they knew. It's to just say, until we receive all the documentation, that wouldn't help, but to say, these are the pieces of documentation we need. And once we receive all of these, then the clock starts,
Exactly. So we put that in the PSA also. These are all the list of documents that, like, we go to a lender, like they give Freddie Mac list or Fannie Mae list. This is exactly what we need before this clock starts. Yeah, great.
Yeah. So going through the due diligence process, did you have any issues that came up or things that came up that you weren't aware of that kind of made you step back a little bit?
Yes, we definitely retraded this deal. When we saw a tour, like a outside tour, the construction was good. The roofs are newer, so they were all good. But we went to deep went to all units, got our drones flying in for our roof inspections, our HVAC inspections of the foundation and the sewer lines, everything, all the good stuff. There, we found some building code violations, slip and falls, some railings issues. HVACs were too old to be replaced. Like we found, when we get this due diligence, we will work with the inspection to the company to give us good conservative estimates. Give us everything, that possibly that can happen, interior, exterior, everything, right? So we know the amount that they gave us a little bit bigger, but we just took it, say, hey, this is $180,000 of deferred maintenance on this. We wanted to retrade. I know this is higher side, but we use this as an ammunition. Okay, take this report. Hey, they know, even they sell it to someone else, they also do the same inspection, right? So then we kind of some back and forth again, some pause. But you should do it as early as possible in this game. Don't wait till 18 days or in 28 days and then start this thing. You had to hit the clock should start really, really fast. You should have within the first week, the Freddie Mac come in or first 10 days, and then your inspection do unit by unit, everything kind of scheduled so that you have all these reports ready for you. So then we took it back, and then a lot of back and forth. And we kind of settled at 50-50. They reduced the price for $90,000, and we are kind of comfortable. We know that this is 180 is really on a high estimate. We got reduction for $90,000. We were not anticipating, in a sense, we don't have a mindset of retrade. Usually, a lot of these brokers don't like if you have a mindset of retrade. We were comfortable with our price. We just tried because this is what it is, and we were able to get the 50%.
Now, do you, when you go back and you find something in due diligence and you go through this retrading process, are you trying to get the reduction in the sales price, or are you trying to get credit at closing?
We tried that. Somehow lender was not that happy in the credit. We wanted actually that. I need to talk to a few more people who did this. I saw talked to a couple of people who did that. That's pretty good. I don't know. Have you did anything, Dan, like that? No sense, got a credit in stuff reduction?
Yeah, we haven't had any credits at closing because we really haven't had any properties with some major stuff go on with it. But I know I've interviewed a couple of people that have actually done that, where they get the credit at closing, so they have the cash to go ahead and do those renovations instead of having to add it to the capex or raise more funds or whatever. Just makes it a little bit easier, I think, if the lender will let you. And I think that's the key thing is if the lender will let you.
Somehow they were not happy that so they want the reduction, so that it's a good thing for us. Since we got reduction, our leverage was much better. The Freddie Mac was also happy to lend this property with that newer price, less than $90,000. But I see 2-3 things can happen. Either you can reduce the money, can give cash at the closing table, or some sellers will put in escrow. That you cannot take that money, but you can use it for rehab.
Yeah.
So either of 3 things can happen. But as you said, work with lender, seller, and the situation. Cash is better. If I get $200,000 cash in closing table, I would be more than happy.
I think a good hybrid or a good compromise for that would be negotiating with the seller to just, like you said, put that amount in escrow, and then you can use that to pay for those repairs and renovations and various things like that, so that it's a credit at closing, but you don't get access to it until you're actually doing the renovations. And then, but that way, usually you at least get to use that money for what you were intending to use it for, which was getting those areas repaired.
Yeah, for us, we just got a reduction price. We kind of we did an amendment of the contract with the new price.
Yeah, that makes sense. So, how did you actually finance this particular project?
Yeah, it's a Freddie Mac loan.
Small balance loan.
A small balance
SBL.
Loan, Freddie Mac. Yes, SBL. We got 10-year fixed loan, 5.01. We got for. We had some hiccup on this property, since I had other experience before, but they didn't consider as all this in this year, Freddie Mac. So we got to take a hit. Our 3 years interest only became 1 year interest only. But the next deal that we did, the 32 unit, that was all fine. Like we got a 3 year since our existing Freddie Mac, they know me. So
why did they reduce it from 3 to 1?
they were like, no, since this is I don't have experience. We already put the experience of I'm a PM, but somehow they were not comfortable. They want to either they gave us two options: reduce the loan proceeds or 3 years interest only to 1 year interest only. So we took the interest only to reduce to 1, because that doesn't affect our IRR much. Maybe the IRR is better now just because we're paying the principal back from year 2, but the cash on cash is affected.
Yeah.
Since we had some room there, we can continue. Our projections were a little bit down after this. We sent to the investors saying that our projections will be less on cash, but overall numbers are set because you're paying back your principal from year 2.
Okay. And what was the hold period on this one?
Projections for 5-year hold. You know the situation, right? It can be 2 years, it can be 80 years,
Yeah.
based on the market condition. But we can hold still 10 years, so which is good for us.
Do you project that you'll hit the returns sooner than 5 years and be able to exit sooner?
I have not promised anything, or I have not told anything. Our typical 5-year hold.
Yeah.
Is what
Okay.
we want to
But
make.
it's possible, depending on how the market goes, that if you hit your returns sooner, that you might exit just based on how the property is performing in the market and various things like that.
Definitely, but it takes 2 years at least. Like we wanted to turn 30 units. There are people who are doing 30 units within 3 months, 6 months, but we wanted to go slow. We don't want to go that faster.
So why did you only want to do 50% of them?
Typical syndication, right? So you don't want leave some meat on the bone for the next buyer. So if you just do everything, people might buy it for yield play or something, just for individual investors want to buy it as a cash flowing asset, but not another person what's the value at here for me, right? So we want to do 29 units and leave the 30 for the next buyer.
What kind of renovations are you doing on the interiors?
Most of the units have either tiles or vinyl flooring, Dan, but some still have carpets, and all the kitchen completely classic, 1990s kind of stuff, right? So, and we're primarily focusing on the kitchen. We're going to refinish the cabinets and change all the appliances, and we get the consistent feel, and either tile or vinyl based on how these buildings are kind of structured. So most of it will be vinyl flooring and new paint. It's just I don't want to over improve on the submarket. This is a C property, so I want to make sure that I don't maybe between $3,000 to $4,000 is what I'm thinking on every unit. Onto the lower end, $3,000 most of the time. So renovate these units, raise the rents to the market. The rents are $75 to $100 below the market. There is a comp right next to this Casa Grande, which we are trying to target, which is good for us. Just match to the neighbor. That's it. So we're not doing over stuff here. Just match to the neighbor, renovated property, and then raise the rents to whenever there's a turn happen, not for the existing. Yeah.
So you basically already have your business plan proven by the market, by the property across the street or beside you that already has renovated their classics to better units, and you're basically and they've already pushed the rents, and you're just gonna do the same thing on your side, move them from classic to renovated and push the rents up.
Exactly. We just use their modeling for our comps, and we're working towards that.
And with this number of units, I'm assuming you probably have off-site property management.
It has a leasing office. We're converting to a gym. Because our property management company use a lot of this technology. They don't use online on-site staff, especially on this specific unit property. Anything that's done 70, 80, they can just directly use with the technology, Rently. They're 24/7 leasing, all the things that they have. They don't need an on-site staff on this. But they also hired. One good thing for us is they hired the maintenance person who is actually worked on this property into their payroll, which kind of helped us a lot. So
you're able to use their maintenance person that might work on your property, but might work on a couple other properties that they have as well. So you're sharing that payroll expense instead of having to have it all in one.
Exactly. And then the 32 unit what we bought, the reason I just kind of sent it both to you is it is half a mile away from this one. The idea is to use this person for these both the properties, and the idea like in the next 2 to 5 years is to sell these two as a portfolio since they're half a mile apart, same submarket, and then renovate this to 50% units and sell.
So it's the same asset class, just a little bit down the road.
Yes, half a mile. It's the next street, Hyde Park. So this is in San Juan. That is Hyde Park. Half a mile, you can walk to the other property.
Okay. And let me see here. How did you structure? Well, before I go with that, let me ask you. So you did the Freddie Mac small balance loan. How easy or how hard was it working with Freddie Mac? I've heard both sides of it. So, obviously you've done a couple of deals now with Freddie and their SBL program. So can you share a little bit of a insight into that program?
Yeah, I was not expecting that they will grill this much. In a sense, like I was thinking, usually they accept the PM, the property manager's experience. They have pretty much experience. Like they had 1,200 doors. I was thinking they can use the property management experience for Freddie Mac, but they were not. They were like asking so many questions. Like, they grilled a lot. It's just like, what kind of experience you have, how many, like, even we tell them this, we are already managing, these many properties here in Jacksonville. Since they were like less than 1 year, they didn't consider me at all, those at all. So it was tough. It was tough. Like, we worked with Freddie Mac a lot. It's like, we already have another property under contract. We said like we're going to give more attention to these properties. We have 5 properties right now in Jacksonville, Florida, and we answered all their questions. And then you saw that, right? We got a hit with the interest-only loan from 3 to 1 year, but we took it just because the leverage at the time we already raised the funds. We were in the last stages of closing. We wanted to keep the leverage what we got and then reduce the interest-only, which was not a major hit just because you're paying the principal back to yourself. So I was not too much worried on that.
Yeah. So how much are you spending per door on CapEx on these?
As I said, like 30 units is what we want to renovate. So 2 to 3,000 per door. And our total CapEx budget is 125.
Okay.
At this point.
So you wouldn't necessarily need to start with a bridge loan to do that and then move into a permanent or anything like that.
No. This is 98% occupied, no external deferred maintenance, perfect candidate for Freddie Mac. Because if you have a lot of rehab dollars, you suggest to do Fannie Mae instead of Freddie, where you can get some dollars on rehab as well. But this is perfect for Freddie Mac. We're happy with that. With the terms were really great. Except this thing for the next one also, we got 81% leverage, pretty good terms.
Is this one assumable?
It is, all assumable loans, step down, penalty 554432221. Yeah. So yeah, so I was getting like a pretty good interest rate on a yield maintenance. Then I got a loan from first hand saying that's not good. Like, I was talking to all my other people, like, even Mark, and he said, like, don't go with yield maintenance, especially even if you, especially in your starting stages of career, like just pick step down. Do not blink. Later on, if buying something on your own for long-term stuff, maybe yield maintenance. But do you guys do yield maintenance or all?
No, step down.
I'll step down. Yeah, I think that's at least for me. I took a hit. Like I took a hit of 0.25% to convert to step down.
Mm-hmm. Yeah, I mean, I think that's definitely a smart way to do it. And I think the other thing that kind of comes up here is, there's definitely differences, like you mentioned, between Freddie Mac and Fannie Mae and even the bridge loans. In determining which one to go with, are you going through to get your debt? Are you going through a broker, or are you going direct, or how are you working there?
Direct to lender. So lender is CBRE Capital.
Okay, it's going straight through CBRE there. Yep. Are they also the broker on most of your deals as well, which helps from that standpoint, or does it not really matter?
No, they are not brokers on any of these deals.
Okay.
They're just like capital partners for.
Okay. All right. And how did you structure the deal with your investors?
So this is my first syndication. Like, some of them, like more like a friends and families, it's just I just did typical one-person asset management and 90-10 split, a simple split. And since I'm the only person, got most of my pieces of the puzzle myself, I said this is fine for me. Uh, but yeah, so for a bigger, let's say if I buy at a 150 unit with another partner, this might not make sense at the time. But I gave most of it to the investors.
Okay. And this was your first indication. So you did 1% asset management, 90-10 split. Any fees, any acquisition, disposition, refinancing, something like that?
Nothing. No fees.
Okay. So just a straight, simple 90-10 and 1% asset management.
Yes. Yeah.
And is your 1% asset management on the income or on the overall investment?
On the gross income.
Okay, the gross income, cool. And how much money or capital did you have to raise for this particular project?
$700,000.
700,000. And how did you find your investors for this particular deal? Because obviously with the syndication, you're doing 506B, and so accredited and sophisticated.
Yep.
How are you finding these investors?
So friends, family, and extended this. Since I got first 3 deals with friends and family, this is more like an extended friends family. Hey, you have your your acquaintances. If you can kind of getting my proper MailChimp CRM account set up, make sure I add these people, send some newsletters to these people, right? Started already doing this because I already did 3 deals this year before this. More like an extended friends family. And meetup groups and conferences, and then other Facebook groups that I have. I'm part of Neil Baba's Facebook group, part of Mark Kenny's group, and Jonathan Family groups, and then other groups that I found some of the investors, and some conferences that I attended in 2018. I attended 3 conferences, and local meetup groups in California. That's where I found most of my investors.
Yeah, I'm sorry I missed you a couple of weeks ago. That storm that snowstorm that kept me from coming out there to California. But I'll get out there again so we can meet one of these days.
Oh, sure. The breakfast in San Jose, we missed it. Yeah, yes, definitely. Yeah, I was looking forward for that. And we have this MFIN summit. I just wanted to talk to you the same things what we discussed before the podcast. How you're doing all this stuff. Yeah, sure. Definitely next time.
Yep, absolutely. Well, my other question I have for you here about the capital is how many investors do you have now with that deal? Because I know your minimum investment, I think you mentioned when we were talking about it in the green room was $50,000. Mm-hmm. So minimum was $50,000. You extended family, friends, various things like that. $700,000. So how many investors did you end up getting into this deal?
12 investors, Dan. 10 people invested $50,000. 2 people invested $100,000 each.
Okay.
The total with 12 investors, we raised the capital that we required.
Okay, so that's cool. That's a good number of investors there. And how many of them, or what percentage of them were maybe sophisticated versus accredited?
Yeah, I think half and half. Seems like some of them were really really sophisticated and accredited as well, like high net worth individuals, which I plan to work with them a lot in the future. So just they want to start whatever I'm starting right now. Some really new to multifamily, kind of help them, what is apartment investment, starting from that, make them sophisticated in the past few months, give them all these newsletters, knowledge, videos, webinars, whatever I attended, kind of made them sophisticated in the last few months.
Sure.
So they're really excited about apartment investments as well, getting this passive income. Mm-hmm. And some of these 12 people interested to partner as well in future, getting into more active role as well.
Mm-hmm. And obviously these people, this was the first time they invested with you for the most part, I would assume, unless they JV'd with you in the past, but for the most part, it was probably people who it was their first time investing because it was your first syndication. So what kind of what kind of communication do you give your investors after you've closed on a deal? Are you doing monthly distributions? Are you doing quarterly? Are you doing monthly updates? How are you communicating with investors?
Yeah. So all these 12 people, I never met them before 6 months. If 6 months before, I don't know all these 12 people, that is good thing, right? You can start networking. This thing works in the sense, you don't need to only invest with the people that you know before from past 15, 20 years. So 6 months before, I don't know them. So after this, I do a lot of constant communication in the process of closing. And after we closed, we had a party, welcome party and year-end party at the property a couple of weeks back. It was like we sent this information to the investors. And I do monthly updates on the property and the quarterly distributions. Right now, I'm evaluating softwares for IMS, CrowdSheet Connect, Update Capital. So we might go with Update Capital. I don't know if you heard of that. So it's investment management system where I can put all the deals, all the waterfalls. You can do monthly distributions there. Have you heard of IMS CRE?
Yes. I've heard of the platforms, just not that particular one.
Yeah, it's the same. Update Capital is the same. Cater towards like growing syndicators. Like IMS is more like a top of the cream. It's more expensive. So I'm trying to get all my private properties into to Update Capital to get. They can with my mobile or online. They can see all information about. I don't need to again send this in different communications to them. They can check anytime, and that's what I'm trying to. So right now, monthly updates and quarterly distribution.
Okay. So I have two last questions here to kind of wrap up the conversation about Casa Grande. And if I can update my document here, so it's kind of a twofold question. Okay. And then I'll wrap it up with one final question after this one. So this twofold question is first off, what was one thing or what was something that you found easy during this entire process that, you maybe thought was going to be harder, but it ended up being a lot easier than you thought?
Oh, one thing is easy.
I know.
Just like, I was thinking the 506B process is will be really tedious, and the webinar process, somehow those two kind of, 506, like with my attorney, it was all like smooth. And the attorney helped me also in all the e-signatures and following up with investors, that was really good. With the help of my attorney, got the 506B properly done, easily done. And the webinar, I was like a little bit nervous, like have this webinar, with this number of people, what's the questions, how they will be, will they be committing soon or later? I need to follow up a lot. And those two, the webinar also went fine in the sense, I still need to follow up a lot. We raised till 2 weeks before the closing also, but that's a different story. That's because at the time, until I went to Adam Adams conference in Denver, I didn't know the difference between raising money and calling for capital. So, I wanted to be in a calling capital zone where you need to have all your investors before even getting a deal. That's a good spot you should be, right? So I was desperate, even after the webinar, sending to so many people, hey, following up, have you listened to the webinar? No, I'm busy listening to the webinar. So it's just constant following up, again, working with them, coffee again, explaining them more about the questions. Yeah, that was a little bit difficult, but overall the process of just doing these webinars and with the Zoom, I really like Zoom. And then the 506B process was not that complicated.
Sure. Who did you use as far as your attorney for that?
My closing attorney in Jacksonville, Florida, Kyle Peters. So he helped me a lot, just all the transaction, coordination, and everything.
Yeah, it's very similar to our attorney we have in South Carolina, North Carolina. They pretty much handle both sides of it. They have the ability to do both instead of having to have two separate attorneys for that.
Exactly.
Makes it much more cost effective, especially as you start to do more and more deals too.
Exactly. And then he's also tech savvy with everything, e-signatures, directly work with the investors. Instead of I following up, the attorney follow-up stuff with the investors with a little bit polishness. Okay, you're done with your subscription documentation. You have any questions? You can wire the funds now. Okay. Then me saying, chasing, hey, annoying maybe, I don't know, to investors.
Who are you using for cost segregation?
I'm still evaluating a few. I got two, three people. Definitely, I'll be zeroing on one. So I got a good quote for one of the company. I'm still evaluating and then finalizing it.
Good, good. So the twofold portion of this question is now going to go to the hardest thing that you went through and you did through this entire process that maybe in the beginning you thought was going to be easier, but it ended up being much more challenging.
Yeah. So insurance. Insurance, I thought like it's just pretty easy. But initially, I was even thinking like insurance is more like Geico, like 15 minutes you can get a quote, something like that, right? So you
It
get
doesn't work
15%.
that way.
It doesn't work that way. It's just like, who? I was like, only on this property, I learned a lot about insurance. Um, I was thinking just like a line item for me, which like put like $350 or $400 per door. I'm like done on this thing. But I was like, wow, that was like the broker gave under like in the OEM $12,000 for the insurance. I underwrote it $18,000, 300 per door. We got a quote for $29,000. Oh man, that was like a make or break the deal. Then we were panicking, and the reason was that the biggest learning for me is that we didn't check the loss runs. There was a big claim on this property, a slip and fall for $850,000, screwed up everything, and then it hit us hard. Then again, relationships, like went to the broker, hey, like you gave me this. Then I said, we have an insurance arm, why don't you deal with, like, don't deal with small people, right? Then we went to insurance company. They insured 350,000 units in the US. They gave us they said like, no, you should have a master insurance policy, not a individual insurance policies. Then we created a master insurance policy. We got a pretty good quote of $18,000, $1 million liability, and we had an umbrella coverage as well, with for $3 million. Pretty good deal. And then we added the other properties also into the same bucket. We saved a lot of money on that. So it was pretty hard, a lot of learning, kind of a make or break a deal, but ended up, we were close to $19,000, including the umbrella insurance policy. We were very happy with that.
Mm-hmm. So that learning process helped you save on all your other properties too.
Yeah, learning. But actually, that was like really panicking, like it's like a really bad situation to be in. But yes, but kind of came out of that luckily, and then helped both in learning and also what I need to do next deals. Give me the last runs. I wanted to see it before even submitting a PSA. Yeah, so those are the things, kind of hard way to learn. But now it's in your memory right now. So whenever you see a deal, I want to underwrite, like with Dan also helped in the other Dan, Danny. Say like we saw the underwriting. I came to both the parts of the underwriting webinar that you guys did. Asked so many questions to Danny. He helped me how to underwrite this insurance in the future, and also make sure that we actually ask for loss runs. Yeah, so that's the learning.
Yeah. Well, I really appreciate you taking some time to be with us here today on the podcast. I know I've learned a lot, and I know the people who have joined us from the either whether they're watching us on the YouTube channel or listening to us on their drive home from work onto the podcast. I know they've learned quite a bit. This game of multifamily syndication and just multifamily investing in general is a always continual learning process, and we're always learning. I think these episodes are very valuable. I appreciate you coming on, sharing your information. We'll also have a one-sheeter available for everybody to get access to get some more of the high-level details of this particular deal and project. So thank you again, Rama, for joining us and taking some time out of your schedule. Looking forward to having you back again as you close more deals in 2019.
Sure. Thank you very much, Dan. It's my pleasure to be on your podcast.